A very good morning to you. Thank you for staying with KBC Channel 1. It is time for BizCheck. My name is Betty Kiptum, and Lensa Odingo there is my colleague on the sign language interpretation. In the first hour of the program, we would like to discuss matters investment and how the African investment landscape is and how you can access investment options across Africa, taking advantage of both the local, continental and international markets. And to have this conversation with me in studio is Radhika Bachu. She is the Chief Executive Officer and co-founder at Ndovu Wealth Limited. Thank you very much for joining us.
Thank you, Betty. Thank you for having me.
Welcome, welcome. Just give us a context of where we are in terms of investments in the African landscape.
Yeah, so I think the investment market actually, especially speaking about Kenya, is actually quite nascent. We started the Nairobi Securities Exchange in 2000, so it's only really been around for 26 years, but it has made significant progress over time. So we, if you look at the rate at which Kenyans are investing, historically, it was only not long ago, where only 40% of us were banked, and today 2% of us actually invest in capital markets. So we still have a very long way to go. And the market has grown significantly. We now have instruments such as unit trusts, which are collective schemes where you can take your money, invest it, and it's managed by a professional. We also have infrastructure bonds that everyone's really familiar with, especially the infrastructure bonds where the government uses to raise money to build roads and dams and things like that. And just generally as a market, we have a long way to go, but companies like Ndovu are helping us bridge the gap between the everyday consumer looking to invest and grow their wealth responsibly.
2% is a very small number. And I would like to hear from you what challenges Kenyans and Africans face in accessing these investment options. Is it a case of not knowing that they exist, or affordability? What is the challenge?
So I think the first challenge is financial literacy. So we are not taught how to manage money at school. So typically the average Kenyan, and actually an average global individual, will go to university, study, but they don't know how to manage money. So financial literacy is not just a problem amongst African countries, it's a global problem. And there's a lot of work being doing to improve that, but actually when you first come into the workplace, you're taught how to make money, but you're not taught how to manage it. So the first step is being unaware and not knowing that if you were to make smarter decisions with your money today, you can actually grow it, and it can become an additional revenue stream. Secondly is that actually, if you look at the African continent, we're 54 countries. That means there's 54 different regulators. So if you are an African, today you can't sit in Kenya and access the Rwandan market. You can't sit in Uganda and access the Kenyan market. It's actually very difficult. Yet if we were to do that and make it easy for Africans sitting in the 54 countries to be able to invest in other countries, we could drive significant economic development, because essentially what is the capital markets? It allows retail investors to participate in owning companies. So let's take an example like Safaricom. You could invest in Safaricom, you do use it daily as a line or broadband, but you then become an owner rather than just consuming the product. And the challenge is that there's not enough information around the mindset change of, we should be, yes, consuming these products, but we should also become owners. And so when you are looking to invest cross-country or within even your local markets, you have to deal with different types of regulators, which makes it really difficult for the average African who is so busy, trying to make a living, and doesn't necessarily have the right tools and skill sets to do that. And I think we're changing that. I think in 2050, there will be change where we will be easily able to, sitting in Kenya, invest in South Africa, invest in Botswana, Namibia, in their capital markets. And it's going to take time and technology to help us do that. But there is growth, because we do see the average consumer on Ndovu becoming a lot more smarter in the way they manage their money, and that's heavily enabled by technology.
Right. I like that you've brought up the issue of technology. I mean, with the 54 regulators and the 54 different markets that are there, it might be a challenge, but it is also an opportunity for an investor. Sitting in the investment space, what would be something that you would like to see from the regulatory perspective across the continent so that we have a more harmonized regulatory environment and so that Africans can access more of these investment options?
Yeah, so to give hats off to the regulators, they are doing the right work. So let's take East Africa. We have the Capital Markets Authority of Kenya, which manages capital markets. And they work very closely together with the East African countries to be able to passport regulations that have been set in Kenya to other neighboring countries, allowing companies like ourselves to actually be able to passport our existing license to another market. So typically the way it works today is if you have a license in Kenya as a fund manager, the steps to get a license in the neighboring countries has been reduced significantly. And so they are working in those ways. But yes, the governments more generally do have to work more collaboratively to make sure when you're setting the regulatory requirements of individuals investing in capital markets, they leverage the same frameworks and the same policy so that it makes it easier for us to transport somebody being able to invest in Rwanda from Kenya. And actually at Ndovu, our vision is Pan-African. We are looking to be in majority of the countries, and of course that will be heavily dependent on how regulation plays out and the ease of us being able to access capital markets. So we're doing that work there, and we would love to see a united Africa where we can easily invest, allowing us to participate in growth in neighboring countries and driving really strong economic growth across the continent.
The capital markets investments have really grown in Kenya over the past, say, 5 years.
Yes.
It's like it has just ballooned. Assets under management for some companies are growing like 1,500% in a year, you know. So there is growth and there is interest there. What is it looking like in the next 5 to 10 years? How is that market supposed to look like?
So actually, the asset management industry in terms of unit trusts in Kenya, that's predominantly money market funds, special funds, fixed income bonds, was actually close to 1 billion, so 700 billion shillings at the end of December. And it's expected to grow to 1 trillion shillings in the middle of 2026. That is significant growth. Betty, exactly like you said, there's been significant growth in this market, and we expect this market to continue growing. Companies like ourselves have enabled that growth as well. We're making it accessible for the everyday individual to be able to invest, monitor their portfolio, seek financial advice, and grow their wealth responsibly. And I think that the fact that there are a lot of companies that are now using technology to enable movement of funds, making payments easier, improving the account verification process, making it digital. Because historically, the reason why capital markets took so long to kick off was, Betty, if you wanted to invest, you would have to walk down to the fund manager. You would have to tell them, hey, I'd like to open an account. And they would take your documentation, and it would take on average 2 weeks to get your account open. Now, with players like ourselves, you can do your account verification within a minute. And it takes out that burden. And if you just imagine the everyday Kenyan now who is so busy, that time saving is making it a lot easier for them. It's reducing friction. And because of that now, secondly, of course, there's social media. So there's a lot of information being passed around. Constantly, we're listening to what Trump is doing in the US. We're listening to what's happening in Europe, with war going on, and people are becoming a lot more aware of global markets. But if you pull Africans back, we're actually global citizens. We may earn in our local currencies, but we purchase in dollars. Any phone, any laptop, you're purchasing in dollars. And so as a consumer, we're very sophisticated compared to the rest of the world. We know exactly which companies are there. And social media has made it even more interesting for the everyday youth. The average age in Kenya is 19. The everyday youth to really think about, oh, okay, if I can own a Samsung, can I actually become an owner? And as a result of that, we're becoming more sophisticated. Companies like us are providing easy infrastructure for you to get started. And therefore, there's been a significant growth in this market, and it will continue to grow. And I'm really excited about this space.
Right. You mentioned the issue of financial literacy being a very big challenge in these investment markets. And saying that we are not taught how to handle money from when we are in school. So we come, we get our jobs, oh, we have money. What do? We pay rent and all that, and then what do we do with the rest of the money? So in terms of financial literacy, I'd like you to speak to a Kenyan who is listening and just tell them the steps to treating money right, you know, simple steps to treating money right.
Yeah, I think, Betty, you're absolutely right. So we, as an ecosystem, have tried to educate a lot of individuals. And if I was coming into a job today, or if I'm working and it's been 3-4 years, you need to think of yourself as a business. And the first thing I would do is say, okay, I am an individual that has values and skills, and I am going to trade my skills or values or start a business in order to create income. And the goal is that even as an individual, I should be looking to increase my income every single year. And once you start moving yourself into that mindset, you actually start thinking of alternate ways to do this. So I'll give you a great example. A lot of our youth are working online digitally in order to make a living. So they're a digital economy, they're either influencers, they're developers as well, who actually export their skill set to companies in the US that are willing to pay lots of money. So the first step is to say, okay, I've got this great education, I've got this skill set, how do I turn it into value? Once you've done that, you have started earning an income. And the first thing you need to do is pay yourself. So the rule of thumb is that you should pay yourself at least 20 to 35%, which means you should save and invest it. Historically, a lot of us would save it, but actually the key differentiator and a really small change is that you need to invest the money. And the way that I would think about it is to say, okay, if I have 250,000 shillings, as an example, I'm starting off, I first need to build my emergency fund. Because you only lose in investments when you don't have a liquid fund that you can draw upon when an emergency happens. And Betty, trust me, emergencies happen. Right? So the idea is that if I can have at least 5% of my wealth in an emergency fund that sits well in a money market fund, then you are okay to invest the 95% of it, because you know that in an event you can draw the money down. Now, the way I would think about investing the 95% of that is actually by building a diversified portfolio which has access to US markets, our emerging markets, as well as commodities, and eventually real estate. Now, if you look in Kenya, we have a significant oversupply of apartments. So do I think, from my professional opinion, that it's a great time to buy real estate? Because of the oversupply, if you don't need that wealth for a long period of time, you can probably buy something a lot cheaper, but is it going to be easily be put on rent? Will you be generating an income? So I do see value for real estate in your portfolio if you have patient capital, but if you're just getting started, you're actually better off investing in a unit trust, like a special fund. So Dovu's launching a special fund very soon, so you'll hear about that in the news. And what that does is, a special fund simply is a multi-asset fund that is has different types of asset classes in it, so bonds, equities, and cash-like instruments, but it's managed by a professional. Right. So you, as the very busy individual, doesn't have to monitor it. But the beauty about Ndovu is that you actually get transparency. And the reason we designed a product like that is because transparency is key to the way you as an individual look and treat your money. So if you can see your money grow month on month by 6 or 5%, 5 to 6%, your mindset changes. You're like, okay, so I have invested 250K in a money market, in a special fund. It's actually grown. I'm going to change my spending behaviors. So just a rule of thumb when it comes to spending, you should not be spending more than 30% of your income on utilities, rent, getting to work. And if you are, you need to downsize. And a lot of people don't like it when I say it. I get a lot of social media scrutiny sometimes saying, are you saying, it's hilarious, you can read the comments. But the idea is the short-term sacrifice can get you along the way. So in a nutshell, what you need to do is think of yourself as a business. You should be constantly thinking about how to increase your revenues, but you must pay yourself first. So the goal is to pay 20 to 30%. And over time, I'll give you a very simple example, is that if you had 100,000 shillings in a money market fund, over 10 years, if you did nothing, that 100,000 shillings would be 500,000 shillings. But if you put that same 100,000 shillings in a bank account because you think you're saving, it is actually you're leaving 500,000 shillings on the table. Because we have complex things such as inflation that erodes away. And the biggest hindrance for the everyday African to start investing is they feel scared and they don't know how to get started. And actually it's a lot simpler. And my advice always is start small and get to a financial advisor. you can speak to. We have plenty of them at Ndovu, and we do it absolutely free because we want to educate people on how to start to how they should think about making money, so that eventually in the long term they have a retirement plan. Because let's face it, Kenya does not have a social program, and your portfolio is your retirement, but also be able to show their children how they should be dealing with money over time. And then lastly, of course, it supplements your lifestyle. So you can enjoy going to work, doing the things that you want to, rather than having to chase a paycheck.
Right. I would like us to debunk a myth, so to say. A lot of people, when they think investments, they're like, I have to get some piece of land. I have to now build, you know, my house. It's not even for rental income. So if you're, as you said, if someone does not have patient capital, how should they look at, say, the 1 million that they have? Yeah.
So actually, when I do some financial advices, depending on your age and of course how much wealth you have, sometimes somebody will say, yes, I have 1 million shillings and I want to buy land. And the first reaction I have is that's a bad investment because land doesn't generate income. In fact, what you're better off doing is actually investing the 1 million shilling in a special fund or global markets, and continue growing that to a point where you have enough capital to buy already, either build a house, because I believe you should have the privilege of building the house. If you work really hard, you do want to build a beautiful property, but it comes at a later sequence in your life. So if you're starting off with 1 million shillings, we as Kenyans have been taught buy land, buy land, buy land. Majority of us do have a lot of land in areas where it's not appreciating. And when you need it as an emergency, you can't sell it and you're selling at a discount. And so actually, if I had 1 million shillings today, I would put it in a money market fund or a special fund so that it can continue growing. And just to give you some examples, money market funds last year delivered anywhere from 8 to 11%. And special funds delivered anywhere between 20 and above on the Kenya shilling. And I think that's a great investment because you're using the little capital you have to generate more income so it can grow faster because of this thing called compounding. And then at a later stage in your life where you're still accumulating wealth and you're still investing, you can then carve out a time to actually build your place. But in the initial, I would invest it so it can grow over time.
Growing money is very important.
Yes.
And how does someone who, is there little income that cannot be saved or invested?
It's a myth. You can invest as little as you like. And I think there's a lot of companies like ourselves. So we are positioned to serve middle income and higher. So our special fund has a minimum of 250,000 shillings, but we have products on the platform that can serve various people. So you can actually access the S&P 500, which is the 500 largest companies listed on the US exchange. The S&P 500 last year generated on average 15% on the dollar. And on Ndovu, you can actually access it with just as little as 5,000 shillings. Now, of course, the reason we did that was we do have an impact. We want to educate the youth and help them get on the ladder. And there's a famous saying, you can't learn how to swim by reading a book. You need to get into the water. So that's the idea behind it. But if you want to see meaningful growth, I always recommend if you're starting for the first time, start with 250,000 shillings. But having said that, you can start lower. And a lot of our clients and the experience we've seen is that people do start slowly, they're consistent, and after that they're like, oh, wow, my money sitting in a bank is earning 2%, and now my money here is earning 15% on the dollar. It's a game changer. And I do believe, because of the nature of social media, everybody wants instant gratification, but investing is such a thing that you get the gratification with patience. And having that patience is very important as an investor. And just general, advice to the younger individuals is that Rome wasn't built in a day, and you have to put in good behaviors today. So invest consistently, and there are tools that allow you to do it, like Ndovu Wealth, so you have no excuse. So if you have any spare change or you've done a side gig and you've got some cash, download the app, start investing, and you'll start seeing how money grows. And actually, if you are young and you're in your 20s, that's the time for you to explore and figure out what you're good at so you can start building multiple revenue streams. But by the time you're 30, you should have invested. And if you can invest earlier, the better it is for you.
Right. Yeah. I like that you mentioned the issue of consistency, because the people who say that, oh, I earn too little, I can't invest, they say that the way you'll treat 20,000 today, and the day you get 1 million shillings, you'll probably treat it the same. Yeah,
Correct.
because of your mindset. It's a mindset problem.
Yeah.
So as you say, the industry, people such as yourselves and Ndovu working towards changing that mindset.
Yeah.
Now, talk to us about having a diversified portfolio. What
Yeah.
does a diversified portfolio look like?
Yeah,
And
so
how
just-
does one achieve that? Sorry.
Yeah. So just to go one step before
Yeah,
that, actually you make a really good point.
Yeah.
So a couple of things. We, with our research, have noticed people eat out a lot in Kenya. Right? And the largest actually expenditure, so we luckily don't have a smoking culture. We have a drinking culture, but actually we have a big eating out culture. And you will see if you had 20,000 shillings, let's say your salary is 40K and you're spending 10K of it on takeout, that's a bad sign. So yes, you need to make some changes. You need to eat well and no, I'm not saying don't eat out, but limit the number of times because you could use that 5,000 shillings that you save every week to actually invest, and that will compound over time and be meaningful. And the other thing I would say is that a lot of people don't invest because they're scared about volatility and risk. They think they can lose their money. And yes, investments do have risks, but if you choose a provider you trust and somebody that is regulated and has a investment strategy of creating wealth over time, you having your money under the mattress is a guaranteed loss because every year you're losing 8% because of inflation. And so actually the biggest loss, I say, is inaction because the money sitting in a bank or you're under your mattress is actually losing money and you've worked really hard to earn that money that you should be investing. So investing, in my mind, is a no-brainer. Now, the big question comes around how do we build a diversified portfolio? So I'll talk a little bit about what's happening in the US markets just to understand how to build a portfolio today.
Right.
So we're living in very uncertain times, Betty. So we have, as you've seen on national news, international news, Trump is trying to throw his weight around in order to drive policy, and rightfully so because he has the best intentions for the US. But we as emerging markets are pegged to the dollar. So a lot of our trade is done in US dollars. We as Kenya are a large manufacturing economy. We import a lot of our raw materials and then we export significant of that to create, so add value and then we export it to create revenue. And so all the industries that we are in actually are highly impacted. And even if you're not in manufacturing, just being a sole consumer who is using technology today, when the dollar weakens, we find the laptop that we buy a lot cheaper, but when the dollar strengthens, we're paying more Kenya shillings for that particular laptop. So as a result of us being global citizens, but living and earning Kenya shillings, we must hold some US dollar exposure in our portfolio. And then of course, so what would that look like today is that if I was building a portfolio, I would have 60% of my wealth in dollar-denominated investments. But today, so when I say dollar-denominated investments, it doesn't just mean equities. So you can hold gold, silver, copper in dollars. And given the noise that is being created by the war that might be on the horizon, the US-China trade tariffs, and now he's threatening Europe and other neighboring countries to participate and support him, it means that the US dollar could weaken. And the best thing you can do in this market, when that's happening in global markets, is actually to diversify into other investments. And lucky for us, we're in Kenya, where we are an emerging market. We can get access to fixed income bonds in Kenya shillings. We can also invest in money market funds, and we can also start businesses, etc., as a whole, in order to be able to balance our portfolio. So today, if you had asked me this question a year ago, my strategy would have been very different.
Okay.
But because of what's happening in the market today, I would say you should have 60% in dollars and 30%, because I do believe, I know gold is at an all-time high, but because of this uncertainty, I have a strong conviction, and so does Ndovu as an investment team, that gold, silver, and commodity and copper and other raw or precious metals will increase in value. So actually you can get access to that. So the big question is, where do I get access to these
where can I
precious
get the gold?
metals? And actually if you download the Ndovu app, you get access to commodities, and they're held in dollars. And then I would also invest in other markets, such as holding in same dollars. So India, for example, the S&P 500 with the US market. The US is too big to fail in my opinion, so it's nice to have an allocation. And then for my 40%, I would look to invest in money market funds and then fixed income bonds in Kenya, and even the NSE. Because last 2 years, the NSE has delivered double-digit returns, and it's continuously growing. I'm really excited for another listing that is happening. I think it shows growth in the market as well. And of course, because we are consuming Safaricom, BAT, the banks, we use them, it's good to also have ownership in them. So you're actually earning as a result of consuming them.
You talked about volatility and risk. And as you said, people are scared of losing their money. I mean, we have seen people lose money.
Yes.
Yeah. So how does an investor identify the, let's call it, safe option to invest in?
Yeah, so I think there's some red flags and some green flags. So first of all, I'll start with the green flag. Well, let's start with the red flags.
Right.
So, and it's amazing because we're both wearing red and green. So firstly, the red flag is if it's too good to be true, it is. Nobody needs to be educated enough. Nobody needs an additional level of education to know that. And when we speak to our customers, a lot of people, our clients will say to us that I invested in this, they said they were going to give me 60% return this year, and it turned out to be a scam. And I said, yeah, because it's too good to be true.
Right.
I think if you, as an average individual, is looking to invest, a good return is anywhere between, on the dollar, 12 to 14 to 16%, and markets have done a lot better than that. That's great. But if someone's promising you 60% return, it's too good to be true. The second thing is them not having a regulatory license. So I think the first question you can ask a fund manager or an investment party, what regulation do you have? And majority of the investment regulations fall under the Capital Markets Authority of Kenya. You can actually log online, you can search. They have a section where it says licensed players, and you can actually search for them. Do your homework, of course, you have to do your due diligence. And then thirdly, I would say is ask them, where does your money sit? So if I was to give you 250,000 shillings, what happens within your ecosystem when you invest it? Does the money sit under my name, under a custody account? When you're regulated, the industry standard is for you to have a custodian that cannot send money to a company's operational accounts.
Okay.
And that is how you know that should anything happen to the fund manager, your assets are secure because they sit with a third party who's a trustee and looks after your interests. And so if anything happens to a company, your assets are still invested. And that's a really, really important question to ask. And of course, if they are transparent in fees and they're easily accessible, you can speak to them. These are all good signs in terms of making sure that your money is not lost, but on a fundamental level. Now, when it comes to investing is a risk. But the most important thing to think about is that am I taking a well-calculated, responsible risk versus just taking a risk? And when it comes to capital markets, history has showed us that if you were to remain invested over time, the best thing about investing is time in the market, that your money will always grow. Yes, the market will go up and down. That is the function of a market. So, when you invest, the idea of a market is the stock market will come up and down because all these companies are doing different things to generate revenue, and that's okay. But as long as you're consistent and you're a long-term investor, history has shown that the returns have always gone up. So if you've been investing responsibly over time, which is looking at passive funds such as the S&P 500 or a special fund, etc., the portfolio manager will do the work for you. And yes, there may be some moments of down, but don't panic. That's part of the market. It needs to come down in order for it to grow. And so the key message here is that it's not about timing the market and taking bets with your money. The best way to moderate the risk and the volatility is to spend time in the market. And my famous saying I like to say is that when the market comes down, just think of it as a sale. So your best shoes are on sale. We always rush to buy our best shoes, right? So put some money into the market and it will recover over time.
Right. And so the work of the regulators in terms of building trust in the market. I think CMA, as you said, and the other regulators have done a really good job. I'd like you to speak to that as an investor. as an investment firm that is operating in this market and the other African markets that you're in?
Yeah, so I think let's look at the history. We've only been around for 26 years as capital markets,
Right.
and the CMA and the CBK have evolved significantly over time, and that is really important because they have been at the forefront of learning and educating themselves in order to understand what have other markets done, how do they regulate these operators. And yes, mistakes do happen, but they've been very quick to resolve and move across that in order to make sure that they're able to regulate these financial companies. And you can see that in the growth in the unit trust market. You know, we've seen significant growth every single year as a result of them doing a good job in regulating the companies around. The other thing I'd like to mention is, I'm sure a lot of us, because of social media and news, have heard about Web3, blockchain, and crypto. So, interesting fact, crypto is, Kenya is Kenya is the number 3 country globally that trades crypto significantly. And crypto is, for those of you who don't know, is a token that holds value, so Bitcoin, etc., that holds value, is seen as an investment class and is quite a high-risk investment class, and it's built on blockchain. And recently, Kenya, with the changing environment, quickly put together a virtual assets provider bill, which goes to show the speed at which they're working to really help us move in a way that we as Kenya don't remain behind while the global economies are adopting blockchain and Bitcoin and such. So yeah, in a nutshell, our experience has been very positive with the CMA and the CBK, and they do move fast. And what I love about them, they're constantly learning, which is the right way to approach regulation.
Mm-hmm. And is there more that you think that can be done?
Yes, 100%. I think in terms of regulating capital markets and moving a little bit faster and being able to, let me start again. So I feel that the CMA is moving at a pace that's very fast. However, the world is changing at a much faster rate. So for example, with AI, there are now AI tools that can predict markets for you. And so they need to be at the forefront to say, okay, how does this impact the Nairobi Securities Exchange? Do we have an AI bot that can trade and generate superior returns that may be an unfair advantage to someone who has access to AI? The second thing is now social media influencers have a significant, and this is a global problem, the way markets are meant to behave fundamentally with changes in policy, the markets don't do that anymore. And the reason is because there's so much information that moves between countries. And I'll give you an example whereby earlier this year when US was saying that Trump was saying that he'd like to put trade tariffs on China, the market sold off, but it recovered very quickly. Historically, that recovery would have taken 18 months. And the reason it recovered very quickly is because you now have influencers like Elon Musk, Mark Zuckerberg, who have so much influence that when they tweet something, people actually follow them. And so fundamentally, the way I see it is that our old macros that would tell us how the market is going to move, so pundits could predict what to do with investments, is changing because now we have external factors that are influencing the changing of market. And that eventually will come to Kenya. And it's actually a really scary thought because let's say you've taken 20 years to build a company, you've listed it, and you have such a powerful source that says, oh, this company is not worth anything, and your share price collapses. There has to be some change in ownership in who is allowed to say what about the public market to avoid insider trading. And so like that, I think there's a lot of work to be done in this market because markets can be now manipulated by external factors, which historically didn't happen. But that change will happen across global markets, I believe.
Right, so it's not just something domiciled on the African continent.
Not at all, yeah. Okay,
so as investors are looking to invest, is it just a matter of returns that they should be looking for? Is it the one who is promising the highest returns, that delivers?
Yeah, so I think when it comes to, we as humans are innately return driven. Right? And we would like to, life is hard. You want your money to grow as quickly as possible. Returns are important, but I do think the key to generating strong returns over a long period of time is diversification and holding a balanced portfolio. And the reason diversification is important is because you're not putting all your eggs in one basket. So let's say you hold fixed income bonds and equities. At a moment where equities are selling off, your fixed income bonds are guaranteed. And of course, you could make a lot more money having all your money in equities, but there's a lot of risk. So I think the balance around looking for better returns is, as an individual, you need to understand what are your financial goals and then build your portfolios around that. So if you're looking to pay for your children's education when you're going to university and your child is 2 years old, as an example, you have 18 years or 16 years to go before they go to university. Actually, that portfolio can run significantly more risk, therefore generate more return. And that is a portfolio you can run a little bit more growth in. But if you are 55 coming to retire at 60 and you have the only income or assets you have in a portfolio, then you want to have 80% in money market and capital preservation. So I think when you think about how to generate portfolio returns and what's right for you, it should be done based on what are your financial goals.
Right. So as someone is thinking about now beginning investing, what is the one thing that you can tell them that they need to either look out for or be sure about before they put their money somewhere?
Yeah, I think it's about speaking to the individual or the company that you're dealing with, doing your research to understand, are they regulated? And are they doing what they say on the tin? When you speak to an RM or the company, are they saying what they do on the tin? And are they transparent? I think those are the three things. And if something doesn't sit right with you, don't go with that company. Like, it's that simple. Humans are a lot more intuitively very smart, and if something doesn't feel right, there's probably something that's not right. So if I was a first-time investor, I would do my homework, look at regulation, but the last thing I will say, you need to get started, because the opportunity cost of you not getting started is a lot higher than you starting and getting your hands burnt a little and learning along the way versus doing nothing.
So we all need to get started, no matter how much we have. Remember, we are having this conversation with Radhika Bachu. She is the Chief Executive Officer and co-founder of Ndovu Wealth Limited, and we are talking about accessing investment options in Africa and beyond. You can invest with as low as 500 shillings, go as high as you want, but just get started. We want to take a quick break here on BizCheck. When we come back, this conversation continues. Do stay with BizCheck. Thank you for staying with Channel 1. This is BizCheck. My name is Betty Kiptum and Lensa Odingo is my colleague on the sign language interpretation. Today we are talking about matters money. How are we treating our money? Where are we investing? And what are the correct investment options? Not correct per se, just what works for us. And this conversation I am having with Radhika Bachu. She is the CEO and co-founder at Ndovu Wealth Limited. We have talked quite a lot, and before we went on break, she was saying, as long as you have some money, just get started on your investment. Thank you, Radhika, for staying with us. We are in the artificial intelligence age, and virtually every industry is adopting AI. What is the impact of AI in the investments industry? I know there are robo-advisors now, and are they going to phase out, phase? Yeah, so what is the impact of AI in the industry?
Yeah, I mean, so AI is going to have significant impact in not just the financial industry, but across the board. And I know there's a lot of noise on the internet saying that we're going to lose jobs. But I actually think that AI is here to increase productivity and efficiency, allowing you to make more money so that you can then invest over time and get wealthier. And I think especially for the financial industry, AI is so already we use AI at Ndovu Wealth. We use it to do customer service. And a lot of you might not, when you use the solution, you might not actually feel that it's AI, which is really great because you can see at the lengths at which it has changed over time. Because if you were using a chatbot message about 7 years ago, you knew it was, it was a pre-populated answer and you knew exactly what it is. But today it actually feels as if you're speaking to a human. And we're in the process of integrating a voice AI that can speak different African languages. How cool is that? But I think when you look at any business, so with the financial industry, we've started with small things such as using AI to increase our great customer service, being able to use it to create social media and content. And so my team is faster and is able to get a lot more productivity out of the work that they're doing, and spending time more on the strategic decisions rather than the menial tasks that you have to do to deliver a project.
Right.
And recently we're also using AI in compliance. So of course, as a regulated business, we have to monitor transactions. We have to make sure that the money that is on our platform meets the AML, so anti-money laundering and policies. So we use AI to really monitor trades on our platform, and it highlights, and then of course the compliance team gets a notification and they then do their double check, which is great because it's reducing the number of people I need to hire, but the quality of the people I'm hiring are more strategic thinkers. But let's now move on to the exciting part, which is using robo-advisors that are AI-driven, or financial advisors that are AI-driven. I think we will not be getting rid of financial advisors. There is this human element. You know, when somebody is investing 10 million shillings, they want to speak to someone. They want to speak to someone human. To them, and actually, even if somebody's investing 100,000 shillings, that's a lot of money to some people.
Yeah.
And they want to speak to somebody because the reality of when it comes to money is it's an emotional thing. You know, it's a trust-building exercise. So I don't think we will be getting rid of financial advisors. What will actually happen is that we, as financial advisors today, use AI in order to better our thinking and our strategy and our investment committee decisions. So I'll give you an example. We have an investment committee that sets strategy for every month. And now they use AI to sift through data, but they do sense check it because it can make errors, but it's reduced the rate at which you first have to download raw data, analyze it, draw insights. Instead, now you can do that within 30 minutes. And so it's just making our tasks much faster. And I think what will be really interesting is how does AI pick stocks? So the portfolio management side of it, which is yet to be seen. I've been reading some articles where some people have used this new AI called a Claude bot. I don't know if you've heard about it on social media, to actually put it on an events prediction market called Polymarket in the US, and they gave it $100 and it was able to convert the $100 into $152. And the idea is that right now this AI can actively go and pick events or investments that could generate a lot of money, and that use is going to be significantly interesting. But other than AI, there's a lot of talk about blockchain. Blockchain has already changed the way fund managers and portfolio managers are recording and distributing data internally. So one of the biggest roles as a fund manager is bookkeeping. We need to make sure that if Betty comes onto the platform and she's investing, she's given us her hard-earned money, she invested on this date, it was this much, and typically this sort of work was done on Excel spreadsheets or a software that you buy. And now with blockchain, you can actually record these trades that are immutable, means nobody can go into the chain and change it. So it increases security, it increases trust, and you're able to hold large amounts of data at a very low cost, again, increasing just the cost of, reducing the cost of doing business, but increasing efficiency. And one thing that I'm super excited about is, right now, if you are sitting in Africa and you wanted to, let me reverse the thing. Right now, if you're sitting in the US, you're an African diaspora, you have this infinity to build back. We'll talk about Kenya. But you live in the US because you need to make more money, you've gone abroad, you come and visit Kenya every few years, you actually also have invested in money market funds. But having to send the money from a US bank account to Kenya is really difficult. And it takes 3 days, you have to give paperwork because the US banking system is very strict. And we've had clients who are trying to do this. And the friction there is to actually be able for him to take their personal money and invest it in a property or an investment to build Kenya is really difficult. And actually, the use of blockchain allows you to tokenize real world assets. So we talked about crypto earlier. Crypto is a token. So we can take Kenyan real estate and make it a token and distribute it on blockchain, where you get access to people all around the world without having to apply for multiple regulation, without having to set up shop in different countries. And Ndovu's goal is, in the next year, to tokenize our money market fund, meaning, and this is using the infrastructure called Base. It's a big company called Coinbase in the US. They already have 8 million users globally on this exchange. And we are tokenizing our money market fund, making it from a real world asset where we're still buying bonds and traditional assets. It's a USD denominated coin. Last year it generated 4% on the dollar. And this year, depending on what we do, it'll have value to it. But now anybody sitting around the world can access it because you can leverage the payment systems, the KYC systems built on blockchain. So I do believe the future of finance is on chain. And what I'm really excited to do is be able to fractionalize, tokenize a real world, like a real estate project, a telecom project that is generating meaningful returns. So bringing private markets to the public markets. And the returns are really healthy. And what that does in turn for Africa is we're now getting liquidity from global markets into this market, and you're generating more economic development, because if you get more liquidity and you have more people investing in countries and back home, you're actually able to generate more economic growth. And it means it creates jobs, it creates projects, and that for me is a game changer. And I do believe blockchain was more so invented for emerging markets like Africa versus the US where banking works. And actually the on-chain activity grew by $200 billion last year. So it goes to show that a lot of our creative content creators are actually using blockchain to be able to receive payment. They're using blockchain to send money to one another. And that digital adoption is increasing at a very fast rate. And we're really excited to tokenize real world assets so we can make them available on a global chain. So in terms of technology, there's a lot of innovation happening. And yeah, we're looking to be at the forefront of it.
Right. So financial advisors should breathe easy. They will not.
They should not worry.
Right. And from a user's perspective, there are all these solutions that are there. But a lot of people, when they hear AI, the only thing they know is ChatGPT, right? So what is the risk of using, say, open source AI to make financial decisions? You know, why do you need a financial advisor?
Yeah. So I think, a couple of things. We know that AI makes mistakes, but fast forward 3 years, there'll be very little mistakes. And the rate at which it is optimizing and improving is out of this world. But you still need, so AI is data driven. They don't understand the emotional aspects. I truly believe investing is emotional. And this is why I think that actually being able to bring African assets on chain, and we could acquire diasporas to invest back home. They already send $53 billion a year home, but now they can send it with a purpose. And that's because it's emotional. So they're not investing back home because the returns are the best. They're not investing back home because they can easily liquidate their money. They're investing back home because it's emotional. And that AI piece cannot sense that. And so, yes, you can use it as a benchmark. You can put in a few questions, try and understand what's the right portfolio for you. But it's the best thing you can't build is experience. And then speak to a financial advisor and say, well, these are my financial goals. This is what ChatGPT says. What would you do in this situation? So the idea is that AI is an enabler. It's here to increase productivity, but there's some elements that it can't replicate, and that's why everyone should not worry that AI is going to take over their jobs, because there is a need for experience and the emotional intelligence part of looking at money and why they're investing. And I'll give you a great example. You know, you might see somebody who's in their 40s that is still building their wealth and would like to run more risk. But AI will say, okay, well, you're in your 40s, this is your liquidity, I think you should run a balanced portfolio. But this individual is saying, no, I know I have future cash flow or an inheritance coming. The cash today I can invest at a high risk. But AI will tell you, well, you don't have that cash, that's a maybe. Your inheritance is a maybe. You don't know if your father's going to leave it to you, as an example, or your mother. And so AI is great, but it's not the answer to everything.
Right, so we need to use it cautiously, so to say.
Yeah.
As we come to a close of the conversation, Radhika, I would like you to tell us a summary of what we've talked about. What should viewers pick up on, and what should they action on? And as you mentioned, with the political and geopolitical climate that there is right now, would you put your money in the USD?
Oh, great question. So I'll start with that first. So I think America is too big to fail today, and I still believe in the stock market. because globally they export a lot of their technology. We're all consumers of Nike, Apple, Johnson & Johnson. They're a big market to fill. But today, if I had to build my USD portfolio, I would actually put more money in gold, silver, and copper, because we do believe in 2026 that will continue to grow. What has happened is a lot of central banks have moved away from holding dollar reserves to holding gold. That's why now gold is at 5,000 in value. We still think that will continue happening. And I think it would be naive of us to say the US market is going to die. The reason I say that is because there's a lot of social media content and creators who want to catch attention. So they're like, the US market is done. It's not. And so the idea is that we would hold the, if you came to Ndova, we'd tell you to hold copper, gold and silver, because they're commodities, they behave differently to equities. We'd also recommend holding the S&P 500 or a technology fund or a quantum computing fund. And these funds have generated double-digit returns in the 20s and the 30s on the dollar, net of fees, net of tax, great products to hold. And then because we're here, I would diversify, not away from holding dollars, but actually holding some local currency or buying India or a different market, as an example. But just to summarize, I think I'll bring it to a close that when investing, understand what your financial goals are, because investing is very personal, but do get started. And today with technology and the amount and how easy it is now to invest, actually not investing is a higher risk because you're losing inflation. And so if you're scared to make that first decision, just think about investing small and then stay consistent and read. And you will learn a lot about investing, and that investing behavior and learnings will translate into your everyday life, making you a human who's grown, and you'll be able to achieve your financial goals much faster.
Awesome. Thank you so much. Get started. Wherever you are, just get started. That is the message from Radhika Bachu. She is the CEO, Chief Executive Officer and co-founder at Ndova Wealth Limited, speaking to us about where to put our money this year and how to make sure that we are doing it safely and in a responsible manner. And as she said, take note of that. Just get started wherever you are. That is the first conversation on BizCheck this morning.